Welcome back to the GoldTime Tracker. Dennis here, and today we're diving into something that most investors completely miss: the hidden signals behind the silver market and why major banks may not have your best interests in mind. Right now, Bank of America has just released a bullish silver target of $65 per ounce. On the surface, that might sound like good news if you're holding silver or thinking of buying. But here's the catch. This announcement came in the exact same week the US Mint announced they were suspending Silver Eagle production due to a shortage of silver blanks. Same week, not a month apart, perfectly timed. This is not a coincidence. When a major bank issues a bullish forecast at the same moment the government restricts retail access, it's a signal. But not one meant for small investors like you or me. It's meant for institutions who already know what's coming and are ready to act. To understand this, think back to 2020. Goldman Sachs issued a public report predicting gold would hit $3,000 an ounce. Retail investors rushed in, media covered it everywhere, and gold surged. What almost nobody realized is that Goldman's institutional clients were already positioned long before the public announcement. The forecast wasn't about helping retail investors. It was about triggering demand so the institutions could sell into it. That same strategy is being applied to silver today. Banks don't issue price targets to help you profit. They issue them once their accumulation is complete, when they need buyers at higher prices. Bank of America's actions over the past several years make this clear. From 2020 through 2023, they were largely skeptical of silver, holding net short positions and forecasting lower prices. Then, in late 2024, they quietly flipped from short to long, around $22 per ounce. No headlines, no fanfare. By the time silver reached 59 ounce, they publicly announced their $65 target. They were already sitting on a 68% gain before telling anyone to buy. That's the reality. By the time retail hears about it, the smart money has already positioned itself for profit. And the US Mint suspension adds another layer. The Mint doesn't produce silver, it buys blanks from refiners. If the Mint suddenly can't get blanks, it's not because silver doesn't exist. It's because supply is being directed toward higher-paying industrial and institutional buyers. Retail investors are being intentionally kept out of the most liquid supply, creating scarcity that pushes premiums and market attention higher. Combine that with the Bank of America forecast, and you have a setup designed to generate demand from retail while institutions quietly benefit from positions they accumulated months ago. The key question is, if silver is supposedly plentiful, why are the world's largest mints struggling to secure even basic supplies? Why are premiums rising faster than spot prices? And why are delivery times stretching from weeks to months? The answer is simple. Physical silver is disappearing from the market, quietly and systematically. Mine production has been essentially flat for years, with new large discoveries increasingly rare and extraction costs rising. Meanwhile, industrial demand is surging. Solar manufacturers are consuming more silver than ever, and electric vehicle companies have doubled their usage in just a few years. Even during price rallies, retail investors continue to buy, creating constant upward pressure. This is not normal volatility. It's a market under structural stress. The US Mint's sudden pause on Silver Eagle production highlights the problem. The Mint doesn't mine silver, it sources blanks from refiners. If the Mint can't get blanks, it means the refiners are prioritizing higher-paying industrial and institutional buyers over retail coin programs. The shortage is not about silver not existing. It's about access being restricted for retail investors. The evidence is clear in premiums. When spot silver trades at $30, but physical coins cost $45 or more, that gap signals a market disconnect between paper and physical silver. The retail price you see doesn't reflect the real supply and demand constraints affecting physical silver. Industrial demand is also intensifying. Solar manufacturers in China are locking in multi-year silver contracts to secure future supply, a move companies only take when they anticipate shortages. Once silver is consumed in solar panels or electronics, it's gone forever. Unlike gold, silver is destroyed in industrial use, permanently reducing available supply. At the same time, institutional players have been quietly accumulating positions, further tightening the market. The combination of restricted retail supply, surging industrial demand, and heavy institutional accumulation is creating the perfect storm. Physical silver is being withdrawn faster than it can be replaced, premiums are rising, and retail investors are increasingly excluded from the market. By the time public forecasts and mint announcements hit the news, the smart money is already positioned to benefit. This structural squeeze is real, and understanding it is crucial to interpreting the market correctly. Now, let's dive into how institutions quietly accumulate silver and position themselves long before the public ever hears a word. Most investors have no idea that when a bank releases a bullish forecast, it's rarely about helping retail make money. It's about timing, positioning, and creating the perfect environment to distribute profits. Every major silver rally starts quietly. The first buyers are not small funds or individual investors. They are banks, hedge funds, and sovereign entities. They accumulate strategically during periods of low volume when prices are flat and retail is distracted. That's exactly how Bank of America positioned itself. Throughout 2022 and 2023, silver hovered in the low 20s, volume was low, and retail attention had faded. During that time, the bank quietly shifted from net short to net long positions around $22 per ounce. By the time silver reached $59, they publicly announced a $65 target. The message is clear. Accumulation happens quietly, distribution happens publicly, and retail becomes the exit liquidity. Timing is everything. Accumulation is never about reacting, it's about anticipating. Banks don't need to announce bullish forecasts to buy, they announce them to sell. And when you combine this with external events like the US Mint pausing Silver Eagle production, it creates the perfect setup. Retail investors see limited supply, hear bullish forecasts, and panic to buy. That's exactly when institutions start selling into the demand they've been quietly cultivating for months. But accumulation isn't just about the metal, it's about narratives. Banks accumulate influence by shaping the story so that retail investors feel compelled to act. Retail demand then becomes a tool for profit. The US Mint suspension amplifies scarcity at precisely the right moment. Institutions already positioned long benefit from premiums rising and retail demand surging. By the time the public reacts, smart money has already secured gains. This is structural, not accidental. Physical silver is being withdrawn from the market faster than it can be replaced. Industrial demand is climbing, and retail demand is accelerating. Institutions are already positioned for maximum advantage, and the public is unknowingly stepping into a setup designed for institutional profit. Understanding this accumulation phase is critical because it reveals why silver moves in the way it does, and why public forecasts often come after the institutions have already made their gains. Now that we understand how institutions quietly accumulate silver, it's time to talk about the retail trap, the stage where public forecasts and scarcity narratives trigger emotional buying. This is where most investors get caught, chasing the market instead of reading it. When a major bank like Bank of America issues a bullish target, retail investors hear it as a green light to buy. Combine that with headlines about the US Mint pausing Silver Eagle production, and panic sets in. Suddenly, everyone feels like they must act immediately, fearing they'll miss out on the next big move. That fear, FOMO, the fear of missing out, is exactly what institutions rely on. They've already positioned long, accumulated quietly, and now they release signals that pull retail money into the market at higher prices, creating the perfect exit environment. Emotional buying doesn't just push prices higher in the short term, it magnifies volatility. Retail investors react to headlines and scarcity, often buying near local tops and selling during minor pullbacks, while institutions control the flow and timing of the real market moves. This dynamic has been repeating for years across gold, silver, and other commodities. Public forecasts are rarely early signals. They are strategically timed to coincide with institutional distribution. While retail is distracted by fear and excitement, the big players are quietly selling into that demand. Understanding this psychological trap is critical because it explains why many investors consistently buy high and sell low, even when the underlying fundamentals are bullish. We can already see this pattern unfolding with silver. Spot prices are climbing, physical premiums are rising, and retail demand is accelerating due to fear of missing out. Institutions are positioned to take advantage, quietly distributing the positions they accumulated months ago at much lower prices. The mint suspension adds urgency, creating the illusion of scarcity while supply is actually being redirected to higher-paying industrial and institutional buyers. Every spike in demand and premium is an opportunity for smart money to sell into retail, which is why timing and perspective are crucial. Recognizing the retail trap allows investors to step back, observe the market dynamics objectively, and avoid getting swept up in emotional reactions. Now, let's dive into the mathematics behind silver, because this is where the story shifts from institutional strategy to structural inevitability. The silver market isn't just about prices and forecasts. It's about leverage, supply, and the sheer mismatch between paper claims and physical metal. Currently, the silver futures market has over 517 million ounces of paper claims outstanding. These include contracts, ETFs, and allocated accounts, all representing ownership of silver that may not actually exist physically. Against those 517 million ounces, there is only about 1 million ounces of registered physical silver sitting in COMEX warehouses as of November 2024. That's a leverage ratio of 517 to 1. To put that in perspective, it's like a bank taking $1 in deposits and lending out $517. It only works as long as everyone doesn't demand physical silver at the same time. The moment a significant percentage of paper holders demand physical delivery, the system becomes unstable and prices can spike dramatically. History shows us exactly how this unfolds. In 2011, the last major silver squeeze occurred when the paper-to-physical ratio reached 520 to 1. Silver traded around $31 per ounce at the time. Within just 8 days, prices exploded to $49, a 58% gain, as the system realized there wasn't enough physical metal to satisfy claims. Right now, we are at 517 to 1, just 3 units away from that historic breaking point. Physical silver continues to be withdrawn from COMEX warehouses, while new paper claims are still being created through ETFs and futures. At this rate, we are on track to reach the critical 520 to 1 ratio by mid-January 2025. Once that happens, the market dynamics become mathematical inevitabilities rather than speculative moves. Adding another layer, the Basel III banking regulations going into effect on January 1st, 2025, will force banks in the UK and EU to back all unallocated silver positions with physical metal. If they can't source it, they must either settle in cash or exit the market. With COMEX registered inventory so low, banks will be forced to compete aggressively for remaining physical silver, driving prices higher. When you combine leverage ratios, physical withdrawal rates, and regulatory pressures, it becomes clear that the silver market is on the brink of a squeeze. The $65 target set by Bank of America is directionally correct but likely conservative, serving more as a retail entry point for distribution rather than the ceiling for silver's move. Understanding the math behind supply, leverage, and regulatory pressure is critical to seeing how this setup could push prices to levels far beyond public forecasts. We've covered the accumulation by institutions, the retail trap, the physical supply crunch, and the mathematics of leverage. Now it's time to tie it all together and understand what this means for investors. The silver market is facing a rare combination of factors: rising industrial demand, disappearing physical supply, institutional accumulation, emotional retail buying, and regulatory changes like Basel III. These elements together create the potential for dramatic price moves far beyond the modest $65 target publicized by Bank of America. What's critical to understand is that while silver is likely to rise, the timing of your entry and your awareness of institutional positioning are what separate smart decisions from reactive ones. Retail buyers chasing headlines may end up buying just as institutions are distributing their positions, while informed investors who understand the market structure can anticipate where the real upside lies. Remember, the US Mint suspension, rising premiums, and delayed deliveries are not random. They are part of a structural squeeze that benefits those already positioned. Meanwhile, the paper-to-physical ratio in COMEX warehouses is approaching a historic breaking point, which means price spikes could occur rapidly and unexpectedly. The lesson here is clear. Observe, understand, and recognize the difference between retail signals and institutional strategy. Public forecasts, headlines, and temporary shortages are often designed to generate demand that institutions can capitalize on. The mathematics, regulatory pressures, and market structure are the real forces that drive silver toward potentially triple-digit prices in the coming months. Finally, a note on risk. This content is for educational and informational purposes only. I am not providing financial advice, and nothing here should be considered a recommendation to buy or sell silver or any other financial asset. Investing in precious metals carries significant risks, including market volatility and liquidity constraints. Always do your own research. Consider your risk tolerance and consult a licensed financial professional before making any investment decisions. Understanding the market dynamics we've discussed will help you make more informed decisions, but it does not eliminate risk. That wraps up our 6-part series on silver, institutions, and market dynamics. Keep these insights in mind, stay informed, and approach the market strategically.